If you're in the market trying to figure out which loan is best for you, let me walk you through that. My name is Zevi. I'm an owner of a mortgage shop in Los Angeles, California. And in today's video, I want to share with you the different loan types that are available, again, depending on your current situation. Let's get started. So the most typical loan is called a conventional loan, and that might be a good fit for you if you're somebody who's got income flowing through their tax returns. Maybe you work in a company, you have a pay stub and a W-2. Those are the type of loans that are most conventional. They're actually called agency and conventional loans. And depending on which area you live, they may allow you to go up to a higher loan amount. As an example, I live in Los Angeles, so there's both conforming loan limits and high balance loan limits, simply because it's a high value area of homes. Therefore, the loan limit increases. Now, you might ask yourself, how would I know if I'm in an area where I could be at an increased value of a loan? You could look that up, and that information is available no matter where you are in the country. Now, the nice thing about the conventional loans is the fact that whether it's a conventional or a high balance loan, the guidelines are very similar, if not the same. And they're underwritten nationally to the same guidelines, meaning that when you're getting a loan, right, somebody's actually buying that note from whether you're getting it from a wholesale broker like me or a bank or a fund, whatever it may be, there's always a buyer, okay? And so those buyers, and you can Google this, are called Fannie Mae and Freddie Mac. And their guidelines are posted nationally for all lenders to follow. And I tell you this so you understand that no matter who's originating that type of a mortgage, the guidelines should be the same, meaning that whatever they need to help you qualify should be the same, no matter whether you're in California or in New York. It's basically the same thing. So that's basically the first bucket of loans. And what really makes this bucket special is the fact that you have opportunities within that bucket to use a couple different things. Number one, a maximum loan to value, meaning that you can come in with a very small down payment. Now, it really depends if you're a first-time home buyer or not, because a first-time home buyer could come in with 3% down or 3.5% down versus somebody who's just interested in buying a property, they could put down as little as 5%. So agency loans give you the ability to finance the most amount of money. The problem with that is that there's something called mortgage insurance. And then the higher you go, meaning that if you finance, as an example, 96% versus, say, 90%, that piece, it's called MI mortgage insurance, is going to simply be higher. Think about like insuring anything else, right? The more you insure, the higher it costs. In addition to that a lot of people don't know, is that loans are layered, meaning that if you have better credit, you get a better interest rate. If you have a greater down payment, you also get a better interest rate. So that means that if you're trying to buy a property with 3% down or 10% down, you're going to get a better rate when you put down a larger down payment, which makes perfect sense because it all comes down to the level of risk that the investor, whomever that may be, in this case, Fannie and Freddie Mac, on agency loans, is taking to basically fund your loan. All right. And so that's one of the reasons I'm not crazy about putting down the least amount possible, even though I completely understand first-time home buyers, especially just trying to get into the house. And also what I find is that, especially in today's age, in Los Angeles, especially where home prices are so expensive, you might have people that are graduating school and plugging into like a really good job that could actually qualify them for a larger mortgage, but they still have a challenge with the down payments, all right? So in a different video, not this one, I do want to touch on the fact that there are down payment assistance programs that you could plug right into this And we're going to talk about that in a different video. I do want to touch on that. It is available just in case. And the beautiful thing about also these conventional loans is that they do allow gift funds. So meaning for somebody who, again, talking about owner occupied here, somebody who doesn't have a large down payment, but potentially has a family member who can help them out. This will be a perfect opportunity to take advantage of the best interest rate at, again, possibly the highest loan amount, just to be able to get into the property if that's what you're trying to do, and also get a gift for the down payment. That's available as well. Now, there's something that I want to discuss with you just on a side note, which is there is, depending on how you structure your deal on these, on these conventional deals, and you could actually do this on another type of loan, which we're going to talk about next. Deal structure has a lot to do with the amount of down payment that you're able to plug into these programs. And that's, again, something that I'm going to touch on another video, because you could potentially structure your deal in a way that takes care of a lot of the down payment and closing costs. All right, we can talk about that in a different video. Now, moving on to another type of loan, which is jumbo loans. Now, jumbo loans typically are slightly different in the sense that the credit requirement is higher, down payment requirement is also higher. And this is something that the banks are really good at, because they get to cherry pick the type of borrower that they want to have. And in exchange, they'll use depositors' money to qualify and fund the loan, but they will request a stricter guideline to qualifying that particular loan. And so as an example, whereas agency loans qualify with, it's called the back-end ratio of 50%, meaning that you take all your expenses and you plug them in to an expense factor, it can't exceed 50%. So basically meaning that whatever it is you make for a living, income-wise, you take 50% of it, and everything that shows up on your credit report and the new proposed payment for the new mortgage cannot exceed that 50% mark, all right? That would be an agency loan. But when you come into a jumbo loan, it gets pushed back to 43%, which is a big challenge, because if you're trying to qualify and income is the issue, then going jumbo might be a big challenge. In addition to that, going jumbo, you typically have to come in with a 20% down payment. So if you're the type of person who's trying to take advantage of the smaller down payments, this wouldn't work for you. Credit requirement. Typically, the agency loans are at credit benchmark of about 620, where jumbo is typically at about 700. Could be 680, but it's typically at 700. All right. So as you see, there are options as you start shifting through. And even though one might offer a better rate than another, qualifying might become a lot more difficult. So you gotta have to ask yourself, what's my position here? What am I gonna be qualified for? Am I a guy or a gal who makes great income but has a low down payment? Do I have a low credit score? Because now, again, we're shifting gears again, going from conventional lending jumbo to, if you've got challenges with your credit, we might have to shift into FHA. Now, FHA has a thing where, remember we talked about mortgage insurance? Well, no matter what the loan to value is, see, on the agency piece, you put down 20%, you're not going to have mortgage insurance, which is great. But if you shift over to FHA, no matter how much you put down, you're still going to have mortgage insurance. So that's tricky, because that also is a higher payment. Typically, mortgage insurance is qualified at about, say, 0.25% on a conventional deal, up to 0.5%, depending on the type of loan that you're getting. And FHA typically has a more expensive mortgage insurance. And in addition to it, it also has something called upfront mortgage insurance, which is 1.75% that goes directly into the deal when you purchase the property. That's money that you typically don't recover, all right? And when you ask yourself on a conventional deal, when does my mortgage insurance go away? Typically, it's when you have 20% equity in the deal, and then you can have the place appraised. and the bank can validate that, or your loan to value drops to 78%. So we basically covered 3 loan programs: conventional, which is also tied into high balance. We discussed jumbo financing, and we touched on FHA. Now, all these would be available to you if you're using your tax returns. Well, that's why they're called conventional loans, all right? Now, the other, shifting to another bucket of loans, would be considered non-QM loans. Why? Because in the QM world, qualified mortgage, if the fees exceed 3%, the loan cannot pass the QM test. And that's why you have this other bucket that's completely available for loans that are non-QM. And typically, the reason you would shift gears into that bucket is simply because you want to use an alternative source of income to qualify, such as your bank statements. If you're self-employed, you make a lot of money, but you don't show any of it, meaning your top line is, your gross sales, and then you line up your expenses, and you basically absorbed all your income into your expenses. At the end of the day, you're left with no income on your tax return, but you want to qualify for a mortgage. This is an opportunity for you to shift gears and go into a non-QM loans, which allows you the opportunity to get a mortgage at a slightly higher interest rate. Typically, from what I've seen, it's about 1.5% higher than conventional lending. And in addition to it, the opportunity to put down a very small down payment goes out the window at this point, because you do have to put down a minimum of 20% to get a decent loan. There are opportunities available with people like sky-high credit scores, like 800, that would allow you to put down 10%. But when you do that, your rate is awful. You're going to get a really bad interest rate, and you're most likely not going to be interested in that. So you do want to put a larger down payment to push that rate lower, all right? And that's already 1.5% more. So those are the buckets. Now, ultimately, if you don't fit into any of those buckets and you're just trying to buy investment property, then you drift into what we called private money lending, hard money lending. That's available, and typically at a 30 or 40% down payment. That's a lot of down payment, but that's if the house is not financeable, meaning that an appraiser is going to go out there, some of the roof is going to be missing, may have had a fire. There's just a lot of issues with the house. There's no kitchen, there's no flooring. It's not habitable, all right? So those are the 4 buckets. Now, I can elaborate on each one of those buckets significantly more. However, what I would prefer is, if you're interested in getting involved in any type of a loan moving forward, depending where you are in the process of wanting to purchase a property, just give me a call. I'm available. My number is 818-697-8220. All right? And my name is Zevi. I would love the opportunity to help you out, simply because, as you can see, I've been doing this for well over 10 years. And when I have a brief conversation with a borrower, I can immediately understand where along the type of loans that we've just discussed, this borrower would be best suited. And then once we know that, then what we want to do is talk about the specifics of your particular loan, which I think is the most important, because every loan is different. And it needs to be packaged correctly before it gets to underwriting, which is basically us loading all the work that we've done in-house to the lender to validate it with hopefully the least amount of questions, all right? So I hope this helps you understand different type of programs that are available. There are other programs available. So again, if you're interested and you're trying to figure out, okay, which way should I be going with this, feel free to reach out. I'll be happy to help you and answer all your questions, all right? If you've enjoyed this video, make sure to like it, so hopefully other people like yourself who are looking for this information can have an easier time finding it. If you have any questions about anything that we've covered here, because we actually covered a lot and it does get very complicated. Even when I give you this information, there's so much passing through my mind as to what I can give you, but I do want to keep this as short as possible. But if you have questions, then please just drop them in the comments below. I'm curious as to what your questions are and maybe what the takeaways that you have from this video, all right? And ultimately, if you want to see more videos like this, then please feel free to subscribe to my channel. I really appreciate you watching this, and I look forward to seeing you again on the next video. Take care.